Did you know that a staggering 80% of investors lose money by following conventional advice? Sounds crazy, right? But that's the truth. The investing game isn't what they want you to think it is. It's not about blindly trusting expert opinions, picking stocks at random, or gambling on the next big thing. In fact, many of the strategies you've been told are designed to make others richer, while you're left behind. Welcome to Factful Finance, where we break down the real truths behind investing and how you can get ahead. No fluff, no misleading promises. Here's the thing. The finance world is stacked with advice that's easy to follow, but often leads to mediocre or even disastrous results. Think about the average investor. They're told to buy low, sell high, diversify, and let time do its magic. But in reality, most end up with portfolios that underperform the market year after year. Why? Because they're playing the wrong game. Take, for example, Noah, a guy in his 30s, starting his investment journey. He reads all the books, follows the news, and signs up for the latest hot tip. Fast forward 5 years, and his portfolio has barely outpaced inflation. What went wrong? He trusted strategies based on generic advice and failed to understand the underlying risks of his investments. The truth is, investing isn't about following the crowd. It's about creating a personalized strategy based on sound principles. Principles that the industry often overlooks because they don't sell subscriptions or services. So let's break it down. First, most of what you hear is centered around short-term gains, whether that's the latest stock market prediction, the hot real estate deal, or the next big thing in tech. These trends are flashy and exciting, but they ignore one crucial factor: risk management. Without understanding how to manage risk, your investments could be doomed before you even start. This brings us to a key principle you won't hear often enough: asset allocation. The truth about investing is the most successful investors don't chase the next thing. They manage risk through a diversified, strategic mix of assets: stocks, bonds, real estate, and sometimes even more unconventional investments like commodities or private equity. Take Olivia, an experienced investor who learned this lesson the hard way. Early on, she followed the buy and hold strategy without considering the need for diversification. When the 2008 financial crisis hit, she saw her portfolio drop by 40%. Fast forward to today, Olivia's portfolio is based on diversification across various asset classes, reducing her risk while boosting her returns. She's not chasing trends, she's building wealth strategically. Now, let's talk about the real secret that the industry doesn't want you to know. Most financial products are designed to make the sellers rich, not you. Think about high-fee mutual funds, expensive annuities, or guaranteed investment plans that offer lower returns while locking up your money. These products may seem like a safe bet, but the reality is, the fees are eating into your returns year after year. If you've ever felt frustrated with your investment performance, this might be the culprit. And here's another truth: compounding isn't the magic bullet. Yes, it works wonders if you start early, stay consistent, and avoid high fees. But too many investors underestimate the power of fees over time. The average expense ratio of mutual funds can eat away at your returns by up to 2% annually. While that might sound small, over 30 years, that's a massive difference in the wealth you could have accumulated. In fact, research from Vanguard shows that fees can reduce your long-term returns by as much as 1.5% annually. So if you're not paying attention to how much you're losing in fees, your retirement dreams might be slipping through your fingers without you even realizing it. But don't worry, there's hope. The key is educating yourself on the market fundamentals. Invest in understanding risk, tax laws, and how to balance your portfolio for the long haul. That's what the pros do, and it's time you did too. For example, let's take Henry, who took the leap into understanding tax-efficient investing. By using tax-advantaged accounts like IRAs and 401ks, he significantly reduced his tax bill while allowing his investments to grow. He also utilized tax loss harvesting, a strategy that helps offset gains by selling investments that are down. With these strategies, Henry's wealth building was on a faster track than ever before, without taking on more risk. The point is, there's no one-size-fits-all answer to investing. The most successful investors are those who understand the core principles of risk management, diversification, and tax optimization. And it doesn't stop there. It's also about time in the market, not timing the market. Trying to predict short-term movements is a fool's game. Instead, focus on long-term growth and stick to your plan. So, what's the truth? The real investing secrets are: 1. Avoid high fees that chip away at your returns. 2. Understand risk management and diversify your portfolio to reduce exposure to volatile markets. 3. Educate yourself on tax-efficient investing to maximize your wealth over time. 4. Don't chase trends. Stick to a strategy that suits your goals and risk tolerance. 5. Use compounding wisely, but remember, fees matter. Now, I want to hear from you. What's your biggest obstacle when it comes to investing? Drop it in the comments, and I'll help you out. If you want to keep learning and stay ahead of the financial curve, make sure to hit that like button and subscribe. Trust me, you won't want to miss what's coming next. If you found this helpful, you'll love the next video on building your own investment strategy. Click on the video on screen now. Stay smart, stay invested, and as always, take control of your financial future.